Hello, my name is Justin Morris, and this is my PepsiCo case analysis for Management 4710. First of all, let's consider PepsiCo's corporate strategy. They use a diversification strategy. The company has also used several approaches to exercise their diversification strategy. PepsiCo is always looking for new opportunities to conduct business in existing industries, as well as new industries in which it is not currently operating. PepsiCo tries to take advantage of cross-business value chain relationships where it enjoys strategic fit. This can be seen especially between its beverage and fast food businesses. PepsiCo has also initiated a corporate-wide strategy referred to as Performance with Purpose, which focused on manufacturing automation, rationalized global manufacturing, re-engineered distribution systems, and more simplified and efficient organizational structures. This plan also placed an emphasis on reducing environmental impact, lowering water and energy usage, reducing use of materials for packaging, giving employees a safe place to work, and giving back to the communities where they conduct business. PepsiCo follows the usual approaches to diversifying a business lineup. They have successfully diversified by acquiring existing businesses as they did with the acquisition of Quaker Oats in 2001. They have developed new products internally. Their better for you and good for you snacks are healthier versions of pre-existing snack options. They began cooking with healthier oils such as sunflower oil with 50% less saturated fats and offer baked varieties of many snacks while also packaging snacks in smaller portion sizes. PepsiCo has also had success in joint ventures. Two examples can be found with Starbucks in their offerings of Starbucks Refreshers and with Strauss Company to market Sabra hummus. Let's consider the business strategies of each of the six segments. First of all, Frito-Lay of North America. They are the branch that operates in the snack foods market. The primary strategic initiative for Frito-Lay North America has been to gain a larger market share of the indulgent and health-conscious snackers. In order to attract health-minded snackers, Frito-Lay began improving their existing product line and offering healthier snacks and wellness products. These were strategic initiatives influenced by their Performance with Purpose plan. Quaker Foods of North America primarily operates in the breakfast foods market. It offers hot and ready-to-eat cereals, pancake mixes, and syrups. Quaker Foods also offers the Chewy granola bars, which acts as a crossover product between breakfast and snack food, acting as a healthier snack option. Oatmeal is often eaten as a snack as well. It creates a nice complementary product to Frito-Lay snacks, with more than half of Quaker Foods' 2013 revenues being generated by better for you and good for you products. Quaker extends the Frito-Lay reach into the healthy snack market. Quaker Foods also offers rice-a-roni rice and pasta side products, which operate more outside the breakfast and snack market and in the side dish segment of consumer foods. This does offer PepsiCo a nice competitive product in that market that is not present in the Frito-Lay branch of the company. Latin American Foods has a great growth potential in both Latin America and other developing countries, as their per capita consumptions are lower than the U.S., where the average is 6.6 servings per month. In these countries, 4 servings per month, and in developed countries, and in 0.4 servings in developing countries. Interestingly, snack preferences in Latin America are very similar to snack preferences in the United States. This is helpful for PepsiCo as they will not have to make drastic changes to products they offer in these markets. Their classic snack varieties are already offered in Latin America, and desire for better for you and good for you snacks are similar in developed countries as well. Next, we have PepsiCo Americas Beverages. PepsiCo had 24% of the market share in liquid refreshment in 2013, and PepsiCo Americas Beverages accounted for 32% of the company's total revenue. PepsiCo is also the second largest seller of carbonated soft drinks with 29% of the market share. However, that industry has been in decline for almost a decade. In response to that, PepsiCo has been able to focus more on the non-carbonated beverages in the forms of bottled waters, juices, teas, and other healthier beverages. PepsiCo has implemented their Power of One strategy in the retail space to help boost sales of their soft drinks. This strategy involves placing Pepsi, Cola, and Frito-Lay products beside each other on shelves. They have also tried to lower calories in their non-diet variety of sodas, and their beverage growth continues to be mostly in non-carbonated, better-for-you, and good-for-you beverage categories. PepsiCo offers all of its global brands in Europe as well. The company enjoys similar positioning in Europe, being the leading snack company with almost a 2-to-1 advantage over the second-place competitor in the Russian market. They're also the #1 snack company in the United Kingdom, with snacking preferences and emphasis on healthier snack options being similar in developed countries. PepsiCo most likely uses similar strategies in Europe that it uses in the United States. PepsiCo plans to offer many of its new products in Europe as well. Again, PepsiCo is the #1 producer of snacks and beverages in India, Egypt, Saudi Arabia, United Arab Emirates, and China. They market all of their global brands in the area and enjoy several regional brands as well. Revenues in Asia and Middle East and Africa have declined from 2011 to 2013 from $7.4 billion to $6.5 billion. Let's consider strategic fit. PepsiCo enjoys benefits from global economies of scale. The company transfers best practices across all of its plants, distribution systems, and service routes. PepsiCo also conducts and shares market research with each of its divisions to help create synergetic products. The Power of One strategy has been implemented across all product lines. The company estimates that it generally generates roughly $1 billion annually in productivity savings, with much of these savings coming as a result of synergies gained in the acquisition of Quaker Oats. The company enjoys strategic fits between its beverage business and fast food business. However, the company needs to do a better job of exploiting its strategic fits in its international operations. Based on these calculations, PepsiCo has had fluctuations in its operating profit margin during the period from 2010 to 2013, while managing to enjoy steady increases in net revenues across most of its 6 business segments. PepsiCo's operating profit margin increased by 5.03% from 2012 to 2013, but only increased by 0.9% from 2011 to 2013. This is due to a decline we see from 2011 to 2012. The net profit margin likewise dropped from 2011 to 2012, but increased by 7.69% from 12 to 13. PepsiCo had a current ratio well over 1 for 2011 and 12. Their current ratio increased by 35.11%. This suggests PepsiCo has decreased its reliance on debt to finance its operations. PepsiCo should have no issues paying current liabilities using current assets in the near future. The company should not let their current ratio get too much higher, however, as it would suggest that they either aren't effectively using excess cash or they have too much inventory. PepsiCo's ROE increased again in 2013. While this is good news for shareholders, it is well above the 12 to 15% average. As with any financial calculation, ROE should not be looked at in isolation, but this coincides with other calculations that suggest that PepsiCo has too much debt, as we will see in just a minute. An ROE this high could be dangerous and affect the company's solvency. While PepsiCo was able to lower its long-term debt-to-equity ratio from 1.05 to 1 from 2012 to 11, it is still too high. This ratio suggests that the company is much too reliant on long-term borrowing for capital investment. A ratio this high could also result in lower creditworthiness and higher difficulty obtaining financing for future expansion. Also of note is the fact that PepsiCo was able to reduce its average collection period from 39.24 days in 12 to 38.22 days in 13. Even though this is an improvement, it still takes them over a month to collect cash from sales. Lowering this time could help the company reduce its long-term debt-to-equity ratio by allowing faster payment of outstanding long-term debt using the cash generated. Of the 6 business segments within PepsiCo, PepsiCo Americas Beverages, Frito-Lay North America, and the European business generate most of the revenues, with 31.72%, 21.27%, and 20.71% of total division revenues coming from these segments, respectively. The most profitable division is Frito-Lay with 34.75% of total operating profits. Interestingly, although PepsiCo Americas Beverages has the highest percentage of net revenue, its operating profit margin has decreased each year across the recorded period. Its operating profit margin decreased by 12.08% from 11 to 13. The least profitable in terms of percentage of net revenue and operating profits was actually Quaker Foods North America. This division only accounted for 3.93% of total revenues in 13 and 5.53% of total operating profits in 13. While not the strongest contributor, the Latin American Foods division has seen steady growth in both percentage of net revenues and operating profits from 11 to 13. Let's consider a few strategic actions. First of all, PepsiCo needs to continue with the Power of One campaign to increase synergy between complementary products. They should continue to focus on the good for you and better for you products and continue developing these snacks to capitalize on health-conscious snackers. They need to reevaluate their supposed strategic fits between existing businesses that are not providing the expected benefits. This includes finding better strategic fits for their PepsiCo Americas Beverages division to help stop the decreases in operating profits. They should consider selling portions of Quaker Foods North America that are less profitable and retain the good-for-you products in that lineup. These snacks could possibly be brought under the umbrella of Frito-Lay if the production costs are not too high and economies of scale would not be lost. Perhaps most importantly, PepsiCo needs to decrease their debt by changing the use of internal cash. As mentioned earlier, they were able to lower their long-term debt-equity ratio, but it is still too high. They should look into shortening collection times to increase cash flows so they can be used to pay off debt. They should lower their ROE decrease their debt, reinvest the cash in paying down debt instead of the investors. This will need to be specifically spelled out to investors as a long-term financial strengthening move. And finally, they need to focus on growth opportunities in Latin American foods and other developing countries, and they need to place an emphasis on creating long-term value for shareholders instead of being concerned with only increasing stock price and ROE. This will result in lower rate of return for investors, but the company will be on more solid financial footing. From my analysis, these are the actions I believe will benefit PepsiCo the most in the long term. Thank you.